There is a business model that has been running for 2,000 years. It collects revenue from its members every week. In most countries, it pays no income tax on those collections. In most countries, it pays no property tax on its buildings. In many places, it is not required to file financial disclosures with any government. And it has been doing all of this, largely without scrutiny, for longer than almost any institution on earth. That business model is a church. The economics of running one are among the most interesting structures in the entire financial landscape, not because of what they produce spiritually, but because of what they produce financially, and because the specific structures vary dramatically by country in ways that reveal in each case a different and equally fascinating set of decisions about the relationship between the state and the divine. Start where all of it starts: the tithe. 10% of income given to the religious community that provides spiritual belonging, moral framework, and meaning. This practice predates organized taxation. It predates modern governments. It predates the concept of a corporation by 1,000 years. From a purely economic standpoint, the tithe is a subscription model with characteristics that no commercial platform has ever replicated. It recurs weekly or monthly. It scales automatically with the income of the congregation. As members earn more, the institution receives more without changing anything.
The psychological architecture is not built around product features or competitive pricing. It is built around belonging, obligation, and in some traditions, the promise of divine reciprocity. The result is a revenue stream with retention rates that most subscription businesses would find unimaginable. People do not cancel their church membership the way they cancel a streaming service. The switching costs are not contractual. They are social, emotional, existential. The community that surrounds a congregation, the relationships built across years of shared ritual, the identity formed through participation, these are the stickiest switching costs ever assembled around a financial product. Now, the tax structures, because this is where it gets genuinely fascinating, and where different countries have arrived at completely different solutions to the same question. In the United States, religious organizations receive income tax exemption automatically. Not by applying for it, by existing. A church does not need to prove anything to any government body to receive this exemption. It qualifies by definition. What makes the American model extraordinary is the reporting structure. Unlike every other type of nonprofit, hospitals, universities, foundations, charities, religious organizations in the United States are not required to file public financial disclosures. A congregation collecting hundreds of millions of dollars per year has no legal obligation to disclose its revenues, expenses, executive compensation, or financial activity to any government agency or to the public. The financial opacity available to a religious institution exceeds that available to a hedge fund. Germany solved the same problem in an entirely different way and produced a model that looks, from an outside perspective, almost more extraordinary than the American one. In Germany, the state collects the church tax on behalf of religious denominations. When a German citizen registers as a member of a qualifying denomination, a percentage of their annual income tax, typically 8 to 9% of the income tax bill, not of income itself, is automatically deducted and forwarded to their registered church. The state acts as the collection agency for the institution. This is not a voluntary contribution. It is a state-administered levy. You pay it unless you formally deregister from your denomination, a process with social costs that many Germans are reluctant to face. The result is a church that receives its revenue through the same mechanism that delivers national health insurance, the government payroll system. The German Catholic Church alone holds assets estimated in the hundreds of billions of euros. Much of this wealth was accumulated over centuries, funded by a mandatory collection mechanism that runs through the state tax infrastructure. In Germany, a citizen who has not attended a church in 30 years is still funding one, unless they went through the legal process of officially leaving. The United Kingdom found a third path. The Church of England manages its financial affairs through an entity called the Church Commissioners, which functions less like a religious organization's finance department and more like a sovereign wealth fund with a theological mission. The commissioners manage an endowment that has delivered consistent investment returns over decades, funding clergy pensions, historic property maintenance, and church operations across the country. The endowment grew to approximately $14 billion by recent estimates. It invests in equities, real estate, and alternative assets with a long-term mandate and no requirement to liquidate. It reported a return of over 13% in one strong year, a performance that would embarrass many professional asset managers. A religious institution sitting on a multi-billion-dollar endowment, managed by professional fund managers, with a constitutionally protected relationship to the state and no shareholders to answer to. The Church of England is, in financial terms, one of the most unusual institutional investors in the world. Then there is the Vatican. The Vatican is not a church, it is a sovereign state.
It has its own government, its own foreign policy, its own diplomatic corps represented in nearly every country on Earth, and its own financial institutions. The Vatican Bank, formerly known as the Institute for the Works of Religion, manages assets on behalf of the global Catholic Church, the Holy See, and associated entities. The total wealth of the global Catholic Church is essentially impossible to calculate. It operates across nearly every country on Earth through hundreds of thousands of independent dioceses, religious orders, schools, hospitals, and charitable organizations that each maintain separate financial structures. Conservative estimates of Vatican holdings alone run into the tens of billions. When global Catholic real estate, institutional infrastructure, and asset portfolios are aggregated, the figure runs into the hundreds of billions. Some estimates, accounting for the cultural and historical value of art collections that include Michelangelo, Raphael, and 2 millennia of accumulated treasure, extend into territory that has no meaningful ceiling. What is certain is that the Catholic Church is the largest private landowner on Earth. What is almost certain is that the full extent of its financial position has never been, and may never be, fully audited. Now the model that is growing fastest, not in the old world, but in the new one.
Across sub-Saharan Africa, across Latin America, across Southeast Asia and the Pacific Islands, evangelical and Pentecostal Christianity has been expanding at a rate that religious historians describe as one of the fastest voluntary cultural transitions in recorded history. These institutions run predominantly on the tithe model, 10% given with the expectation of divine reciprocity. In economies where average incomes are modest, the mathematics of collecting 10% from a congregation of 20,000 people still produces institutional resources that dwarf anything available to local government. In Nigeria, in Brazil, in South Korea, in the Philippines, some of the largest religious congregations on Earth have built campuses, media empires, universities, and real estate portfolios that operate entirely within religious tax-exempt frameworks. Some of these institutions broadcast to global audiences of tens of millions. Some run their own airlines to transport leadership and congregants. Some have built cities. The prosperity gospel, the theological framework that explicitly connects generous giving to material divine reward, is most prevalent in precisely the economies where financial aspiration is strongest and where formal financial systems are least accessible to ordinary people. A church that offers both a community of belonging and a framework for expecting material improvement taps into the two deepest human drives simultaneously.
Viewed theologically, this is a statement about faith and the nature of divine relationship. Viewed economically, it is a donation mechanism with an integrated expected return narrative, and it produces donation rates that exceed what standard nonprofit fundraising can achieve. Now, the compounding effect across time. A congregation that begins with 100 families, each tithing 10% of their income, has a predictable and growing revenue base. As the congregation grows, through natural demographic growth, through active outreach, through the simple fact that a larger community offers more compelling programs, the revenue base grows with it.
As the revenue base grows, the institution can build better facilities, hire better staff, offer more programs, attract more members. This is the same flywheel that drives the economics of every successful consumer platform. But it runs on belonging instead of convenience, and it has been compounding, in some cases, for centuries. The accumulated output of this compounding process is visible globally in the form of real estate portfolios assembled tax-free over generations, endowments funded by 2,000 years of tithing, and institutional networks that span continents and operate with the financial substance of mid-sized corporations while maintaining the regulatory treatment of charitable organizations. Now, the question that every honest economic analysis of religious institutions must address.
What does society receive in return? The answer is substantial and largely invisible in official statistics. Religious organizations are among the largest providers of social services globally. Food banks, homeless shelters, addiction recovery programs, orphan care, hospital systems. The Catholic Church alone operates more hospitals globally than any government. School systems, educating hundreds of millions of children in regions where state provision is inadequate. Disaster relief, community mental health support, elder care, grief counseling. Research across multiple countries consistently finds that religiously active populations exhibit lower rates of depression, higher rates of charitable giving, stronger community trust, and greater civic participation. These outcomes represent social value that governments attempt to purchase through public expenditure, and typically achieve less efficiently, at higher cost, and with weaker relational depth. The economic bargain embedded in tax exemption is this: the state forgoes tax revenue, and the institution continues providing social infrastructure that the state cannot replicate on its own terms. Whether that bargain is honored proportionally varies enormously. A megachurch reinvesting 90% of tithes into social programs in its city is honoring it fully. An institution accumulating assets across generations while providing minimal community services is honoring it less fully.
Both operate within identical legal frameworks. The difference between them is not regulated. It is theological. The oldest recurring revenue model in human history has now spawned versions in every country on Earth, each calibrated to its local legal structure, each producing compounding wealth in the specific way its regulatory environment permits. In Germany, the state sends you the bill. In the United States, no one sends you anything. No receipt, no disclosure, no audit. In Britain, a $14 billion endowment grows quietly in the background. In the Vatican, a sovereign state holds assets that have been accumulating since the Roman Empire. In Lagos, in Sao Paulo, in Seoul, congregations of hundreds of thousands gather on Sunday mornings and tithe before the week begins. All of it running on the same original mechanism, 10%, every week, forever. And in return, the answer to why you belong.